Truth is, I thought it mattered. I thought that
money
mattered. But does it bollocks? Not compared to how people matter.
Welcome, mention and other fine folks, to the Sunday Dispatch of the Black Letter, where we contemplate thoughts worth thinking as we try to navigate through the upside-down, topsy-turvy world, seeking greener pastures on the other side to hopefully come out healthier, wealthier, and wiser. That's the goal, trying to build our best lives under difficult circumstances. We're going to take a look at the markets generally in the economy as well. First up, we'll look at the 5 ingredients that are perhaps potentially available to make another market event or crash become popular. We'll take a look at Americans and how confident they are in their jobs currently and who is it affecting. Of course, as you would expect, it's not affecting everyone equally. And then, of course, we can look at Beth Van Powell's approach to trying to get inflation at an average target of 2%. Of course, I think they'll overshoot it. Anyway, first up, real investment advice. The 5 ingredients for another market event remains. A typical mainstream media claim is the March decline was the bear market, and the next bull market cycle has begun. Unfortunately, March was not a bear market, but just a correction within the ongoing bull market that started in 2009. As such, the 5 ingredients for another market event remains. So a market event, obviously, they're talking about probably another crash. They go over the history of crashes if you want to read about that. In 1999, Congress passed legislation to allow banks and brokerages to reunite. 8 years later, we had a financial crisis and Bernie Madoff. Coincidence? Probably not. Talks about how all these history of crashes and the reactionary response related to them just helps prevent potentially a crash of similar kind. But of course, history doesn't repeat. It sometimes rhymes. And so these crashes and corrections are oftentimes unique and different. In hindsight, the government always acts to prevent the cause of the previous crash after the fact. Most recently, Congress passed the Sarbanes-Oxley and Dodd-Frank legislation following the market crashes of 2000 and 2008. But legislation isn't the cure for what causes markets to crash. The legislation only addresses the visible byproduct of the underlying ingredients. For example, Sarbanes-Oxley addressed faulty accounting and reporting by companies like Enron, WorldCom, and Global Crossing. Dodd-Frank legislation primarily addressed the bad behavior by banks, since the banks have successfully lobbied a repeal of the majority of the act. While faulty accounting and bad behavior certainly contributed to the result, those issues were not the cause of the crash. As John Malden said on the issue, the surprising conclusion that even the greatest events have no special or exceptional causes. Rather, it has to do with the perpetually unstable organization of the critical state, which makes it always possible for the next grain to trigger an avalanche of any size. Sort of the straw that breaks the camel's back, if you will. I mean, of course, you can't figure these things out precisely before time. Of course, it's only in hindsight that we can see with much greater clarity. But of course, there are some of these ingredients he talks about that potentially feed a bull market and that can cause a trigger and a cascading effect at some point when a crash comes. So now he goes on to the ingredients. Mean reverting events, bear markets, and financial crisis are all the results of a combined set of ingredients to which a catalyst was applied. He talks about dynamites, how you can have ingredients for dynamite that by themselves are not dangerous, but when you add them together, you can get dynamite and, of course, an explosion. So the first one is leverage. There is a consensus that debt doesn't matter as long as interest rates remain low. However, it was the ultra-low interest rate policy of the Federal Reserve which fostered the yield chase. The extremely accommodative policies also led to a massive surge in debt since the financial crisis. And here's a chart to sort of explain that visually. Total system leverage. Here's the total system leverage, the orange line. You can see it's exceptionally high, and that's related to the left-hand side. And here it's at about $80 trillion almost of leverage. And the S&P 500 stock price index, and you can see it's very seldom been above that line. In fact, now it's above it almost as much, it would seem, as the dot-com crash. So, of course, the yield chase is helping increase this, and I believe it's not sustainable. Valuations, likewise, high valuations are also inert as long as asset prices are rising. Peak optimism about the markets also come with peak valuations and vice versa, as you can see that here. Is the real S&P 500 index in the gray shaded area. And you can see again, very seldom is it this much higher above the actual cape. And that's the cyclically adjusted PE ratio, often which Robert Shiller uses to give an idea of how extreme valuations are. And you can see here that they're as high as they've been since the 1929 crash, and not quite as high as the dot-com boom. But of course, the market is excessively buoyant in any event. As asset prices rise, there is an eventual decoupling from the underlying value that can be generated by economic growth. But of course, how are we going to have economic growth when we're in the midst of a depression, in my opinion? Here's a bull and bear market total return cycles, annual total return of $1,000. You can see the real total return, PE, these are during bull markets in green, real total return PE in bear markets in sort of the salmon color, if you will. The real S&P 500 index continues to go up, but you can see how it stagnates somewhat during the bear portion of it, except for over here. Mind you, it did dip down and had a couple of dips here. This is the annual total real return on the left-hand side of your $1,000, right? Here's the total return evaluations of PE. So you can see that the PE currently is, well, this only goes back to 2019, but has been quite high for some time and increasingly higher, as high as the tip of the 1929 crash, and only the dot-com boom has been higher. So there's something to be concerned about. Arguably, it could go higher. I don't know how it's going to go as this high, because right then everyone thought that technology was the great savior, would fundamentally change our world, and people lost their minds with ebullience and enthusiasm. This is not the case now, and yet markets are still overly valued, in my opinion. Valuations are the great predictor of future investment returns over the long term, and even if we don't have a crash, you can't expect much higher than low single-digit returns at these rates, PE ratios, in my opinion. Psychology. One of the critical drivers of the financial markets in the short term is investor psychology. Of course, I've said that. People make excuses that the stock market is forward-looking, and it's not at all. It's just investor sentiment that drives the stock market, and maybe they think that the future is going to be hopeful, so that's part of it. But of course, the future remains unknown. Not even the stock market, not even our Borg hive mind that is the stock market can determine exactly that, can read the future. And here you can see the bull trend, and arguably we're still in a bull trend even with this great pullback, and now sort of an accelerated trend, which is not going to end well. And according to some of these other ratios, investors remain extremely complacent. You can see there's very little activity here on these charts, and you can read more about them or figure out more about them, but it is interesting nevertheless. It's important to have all these different ideas and bits of information to try and make a more holistic understanding of where the market is, and this is why currently I'm sitting in cash. Ownership. The critical ingredient is ownership. High valuations, bullish sentiment, and leverage are utterly meaningless if there is no ownership of the underlying equities. And the two charts below show both household and corporate levels of equity ownership relative to previous points in history. So arguably we're higher right now, but not as high as we were back then. So that could suggest that there's a lot of people still sitting in cash on the sidelines like myself. And here's non-financial corporate liability and assets. And the recession's in gray. 10-year treasury rate, 24-month ROC. You can see those are practically at zero now. And here's the non-financial corporate liability and assets, gross value added. And of course, momentum. As prices rise, demand for increasing assets also rises, which creates a further demand for a limited supply of assets, increasing the prices of those assets at a faster pace. But of course, none of these things can grow indefinitely, right? And here's the S&P 500 index versus long-term Bollinger Bands. And you can see whenever they've sort of increased outside of the Bollinger Bands, they usually fall back down. You can see that in the crash of 1929, and especially the dot-com boom, and arguably here is having sort of a similar idea, but we'll see what happens. Like dynamite, the individual ingredients are relatively harmless. However, when the ingredients are combined, they become potentially dangerous. So there's a lot of warning signs, and if we were in perhaps an ebullient and a very aggressively growing economy, these numbers might be fine and in fact indicative of a healthy, exceptionally growing economy. But the underlyings, as you know, are just disastrous and likely to remain disastrous for at least the next 6 months to a year or so, I would imagine. And so these valuations really make no sense. And so I think there's going to be a confluence of events happening when all these sort of valuations or metrics, if you will, come together and they've just become too much. And like dynamite, putting them all together, they become an explosion of on the downside. That's what I imagine is going to happen. You can read the article yourself. Perhaps you'll take away something different. And if so, you'll likely be invested in the stock market. But I certainly am not. I'm going to stay far away from it. Americans are again growing concerned about losing their jobs. This is the New York Fed. And yet they continue almost aggressively to try and make this a legitimate outcome. For the month of August, the average respondent in the New York Fed survey of consumer expectations said there was an 18% chance of losing their job in the next 12 months. That figure is a noticeable increase from the 16% chance reported in July. Worries over becoming unemployed were more pronounced among those without a college degree, 21.3%, and those with a household income below $50,000 a year, 24.9%, perceived a chance of becoming unemployed, which of course is terrible news and quite frightening for a lot of folks, I imagine. And of course, I don't know if my job is going to be 100% secure. I believe I'll be all right, but you never know. And so this is, of course, concerning. And what the Fed is doing is just continuing to create this spread between the wealthy and those that are just working stiffs. And it's only getting worse. And here's another article that talks a little bit about that. Fed must alter habits of a generation in higher inflation quest. It's kind of an interesting article, but also a little bit useless in some ways, but I thought it was interesting nonetheless. Fed officials' persistent chatter about inflation risks may have suppressed actual inflation. And here you can see the FOMC in blue, expressions of concerns about inflation on the left axis is down, and the core personal consumption expenditures price index right axis is also down. So perhaps that's why we're not seeing inflation. As you know, the velocity of money is not increasing at the moment. The Federal Reserve's new push for higher inflation means crafting new tactics that convince Americans it won't clamp down on rising prices. And of course, rising prices hurt those most vulnerable. And again, this is the Fed aggressively trying to cause this inequality to increase. They're either ignorant or they're either purposely misleading us when they don't say that this is making an effect in the way that this economy and society is being fractured like it is. For 4 decades, the Federal Reserve kept up its guard on inflation, beating it back even when it whispered a threat. But price pressures have since become too weak, depressing interest rates and making it harder for officials to fight recessions. Well, they put themselves in this corner too, with 0% interest rates and all the stimulus that they're doing, and they just can't let their foot off the pedal, right? Because if they do, then everything starts to decline the stock market, as if the stock market is the most important factor. The most important factor in my mind in an economy is having people that are not destitute, having kids that can eat a decent 3 square meals a day, all these sorts of things. The stock market is an asinine barometer, if you will, really, of the economy. It's ridiculous, and that's all they focus on. It really, I shake my head at this. You know, it's maddening and really unexplainable, other than they are focused on creating this problem and quite aware of it. And for whatever reason, perhaps they want to have this great reset that they're going to set up in the next several years. Who knows? But you can't pretend to be ignorant about this anymore when folks like myself, not even trained an economist or anything, just with some common sense and curiosity about the world, can figure this out. To fix the problem, Chair Jerome Powell now says the Fed will let inflation overshoot its 2% target and not tighten rates when unemployment falls. Until inflation is sustainably above target, the Fed needs to project perfect calm about price developments. And of course, who does the Fed really project to? It's the 1% or the 10%, right? Those that own assets and those are invested in the stock market. Not folks like you and me who are just trying to work for a living. They really don't care about us. I mean, to believe otherwise is, I think, to be fooling yourself. Unlearning the habits of a generation of central bankers is a big cultural shift and could take a long time to refine. Besides, it'll never happen. There's going to be some upending of the whole financial system before inflation, well, maybe as inflation starts to really become an issue, but we will see. Raising inflation will be especially hard amid the steep recession caused by the coronavirus pandemic, which has sent unemployment soaring in the US and decreased price pressures across advanced economies. Communicating about the need for higher inflation is also complicated by many Americans viewing it as a bad thing. That's what Fed officials heard during a nationwide listening tour last year. So they know exactly what this is going to do. They know that folks are hurting and that they're concerned about rising prices because, you know, the 50% or so of us who don't own any stocks or assets in the stock market cannot see our wealth really grow substantially. And of course, rising prices will just erode any savings that we were able to squirrel away because we'll have to pay for our necessities. It's just maddening, really, that this is going on. It's been allowed to go on, and that folks are not taking real measures to shake the Fed into some sense of wakefulness. It's just unbelievable. Anyway, with that said, that's where we are. We have to deal with it, and so that's why I'm just staying on the sidelines and focusing on cryptocurrencies, Bitcoin primarily as the only option or only asset which I think has some real potential long-term for the everyman and the every woman, if you will. Okay, on to the stock market. Here we are, all green again, not as robust as yesterday, but still green. We could end up having a green week. You can see it's starting to pick up a little bit. I could imagine this will continue into early November perhaps, or late October, certainly before the election. And then, of course, it's anyone's guess. Beyond that, I'm still expecting a big crash at some point. Hopefully that'll happen. If not, I'll remain in cash, I suppose. Okay, let's see how gold is doing. Gold still consolidating as is expected. Eventually it'll take up to the upside, I imagine. That's what I'm expecting. But again, that could take some time. It might sort of consolidate right through to the elections, really, because there's going to be a focus on keeping the stock market somewhat buoyant, or at least from crashing. So we'll see what happens. But that's what I would imagine. The same with silver. Yeah, and here you go. Silver is still also consolidating, and I imagine that will continue as well through to around the election, and perhaps past that point we will start to see the real expectations and crashes and return to reasonable valuations. Who knows? That's just my impression. It's my hope as well. Time will tell. Cryptocurrencies having another good day, up 2%. We're at $355 billion market cap, 5,892 coins for your purchase and pleasure. Bitcoin dominance is at 56.4%. Usually that has been higher than that, I think in the 60s, middle to higher 60s. So it could indicate that we're entering a bull market in altcoins, and then Bitcoin starts to bring in the rear towards the end of that run-up. So, but that's just speculation. It's a nascent early industry too, so we'll see what's happening. Bitcoin up, Ethereum down the past 24 hours, XRP down as well, as is Polkadot, Chainlink as well. Bitcoin Cash is up a little bit. Litecoin up as well. Oh, so interestingly, the Bitcoin wannabes are up, as is Bitcoin, which I guess is not unexpected. Cardano down. So actually quite a fair bit of red on the board here for the last 24 hours, considering that overall, as we see, we're up 2% in the last 24 hours. There's a lot of red on the board here too, which is interesting. Tezos down as well, Stellar down as well. So not much going on. Some opportunities for purchasing. At these rates, I'm still buying Bitcoin, dollar cost averaging into it. I don't see why I wouldn't. So there you have it, folks. The top coins or so. Not really much going on, but a mixed bag. Anyway, on to the online oracle, today's 8-Ball Economist, our trusty sidekick for today's most pressing question. So as you know, we're sort of going through this difficult economic period still, and I'm expecting that there'll be new jobless claims, and I'm expecting them to be above 1 million this coming Thursday, and I expect that to continue through the end of September. So far, on 2 weeks in a row, I've been wrong. So I thought I'd ask my online oracle if there will be over 1 million new jobless claims on Thursday. I think there will be. But of course, the online oracle does not think it will happen. So we'll perhaps see again 800,000 or so. Perhaps we'll see. We'll keep an eye on that on Thursday. There you have it, folks. Thanks so much for joining me. I appreciate you in spending your time here and your comments down below as we try and figure out ways to get through this together, be healthier, wealthier, and wiser on the other side. Take care of each other, stay healthy, pay down debt, squirrel away some savings for the opportunities that will come at some point in the near future. And remember, above all else, dumb sparrow, sparrow.